Eric, we are back after a couple weeks. It's good to see you, my man. How you doing?
I'm good. I'm good. It's been a crazy time in AI, which is a common story. We've seen a lot of movement. We'll have a longer episode coming in a couple weeks, but I think we wanted to get towards some listener questions we teased at the end of the last
Yeah,
episode.
I'm really excited about this. So this is going to be our first AMA listener question episode. This is a new concept for us. We're curious to hear from our listeners if you enjoy this. If you do enjoy it, please leave a comment. Please send us an email and let us know because we'd love to do more. And if not, you can just ignore it and we'll go back to our regularly scheduled routine. A little bit of housekeeping before we jump in here. Please check us out on our YouTube channel. As we mentioned, we are putting the podcast out in video format now. So please check out the 24/7 Wall Street YouTube channel to see Eric in all his glory. And if you have a moment, we really would appreciate a review on Apple, Spotify, or wherever you listen to your podcast. It really does help us get on the right side of the algorithm. And we don't do any ads for this show. So, we'd love to get distribution out there. And if there's someone you think would benefit from listening to the show, please share a link with them. Two more quick things. Eric, a lot of people have asked to see the current full allocation of the portfolio. So we set up a link here where people can visit at any time to see your current holdings. And that is 247wallstreet.com/AI portfolio. We'll also put that link in the show notes here and in the description. And lastly, before we jump in, if you have any questions you would like us to answer on the show, please email us at questions@247wallstreet.com. We will also put that email address in the show notes and description. Okay, Eric, we're going to start taking listener questions. We're going to try and do a little bit of a rapid fire round here. So, our first question we received from Spotify, and that was, have you ever checked out MGA? They outfit the Waymos here in Phoenix. Now, Waymo is one of the more interesting AI companies that we've talked about. It's kind of a perfect intersection of companies for you and me. I love the robotics side, you love the AI side. So, talk to me a little bit about MGA. Have you ever checked them out?
Yeah, and it is worth noting, as you had just said, we got this comment from Spotify. So we've got the email address. If people leave questions, they can email us directly. They can leave questions in Spotify. We had some comments on our last episode. I thank everyone for leaving that. You can also leave comments on YouTube. So there's a number of ways to reach out, and we will take any questions that we can get. So let's talk about MGA. This is Magna. It's a Canadian company. It is very large and diversified supplier to automotive companies. Now, the highlight of Magna is they're cheap. They're trading at about 9 times earnings. Now, the low light, if you pull back your price chart about 5 years, when I had last looked, they had a negative 10% return across the past 5 years. And Austin, the reason for that's pretty simple. Earnings are down across that time frame. So I think this is where we need to look at, will I be adding Magna to the portfolio? I will not. It could be a perfectly fine company and maybe some of their catalysts turn around in the next few years, but it is so large and diversified that even winning a contract with Waymo just isn't going to materially move the needle in a way that we're going to look for investments across both self-driving and robotics. I think it is. Does this deserve a place in someone's portfolio? If you want to add something with a, cheaper on a price to earnings ratio, if you're looking for a rebound in the automotive space, this could be something you look at. But when we're looking for things in the AI portfolio, we're going to look for much tighter association to some of the growth ramps we see coming in the years to come.
And I would just add on that earnings are down across the last few years. Now, I haven't looked at the revenue for this company, but if you're looking specifically for an AI play in this environment where AI money is just sloshing around left, right, and center, and billions are getting thrown around pretty casually, you would want to see a company that has revenue and earnings increasing, or at least revenue. Maybe they're making investments for the future here, but it sounds like one we are not going to be adding to the portfolio today, but thank you very much for the question. Moving on here, Todd reached out to us on YouTube and he asked about ticker symbol NB. Now, this is Elk Creek. I'm actually not familiar with this one, Eric, so I'm curious what you found, but it looks like this is a rare earth element play. It's still in the works. Todd says it's got huge potential. Rare earth elements, of course, are a sort of a flashpoint issue right now in the development of, a lot of electronics, but specifically EVs. And there's been some geopolitical tug of war between the United States and China there. So, what do you see about Elk Creek here?
Yeah, geopolitical tug of war is definitely the way to put this. So we've talked about this kind of oncoming Cold War, where we're going to have a situation where essential technologies are there's going to be different tech stacks between the Chinese sphere and the Western sphere, led by the United States and many of its allies, and this is going to lead to control of certain essential resources. Rare earth minerals is one of them. So I haven't previously done work on NioCorp, but I'm more than happy to kind of check it out and do some analysis. And also a shout out to Todd, a very frequent commenter on YouTube. So we appreciate all the engagement. What NioCorp owns is a mine near Elk Creek, Nebraska. That's in the southeast corner of the state. It's about an hour south of Lincoln, if anyone's familiar with that territory. But what they have is a mine that contains a few key rare earth materials. One is niobium, another is scandium, another is titanium. Now, if we look at niobium and scandium, they're used to essentially enhance the strength of steel, titanium, aluminum. Basically, when you're thinking about things like next generation fighter jets or next generation planes, you're going to need minerals like this. And you can also see in the future applications that AI is going to cause a huge acceleration, robotics, drones, future kind of concepts like electric vehicles. They're all going to need these rare earth materials. So scandium, for example, it's currently 100% sourced from China. Titanium, you've got a lot of kind of capture by Russia. These are clearly, if these are essential resources, you want domestic supplies of them. So I understand why people are looking at this stock. After Todd left his comment, the company received a $10 million contract. It's a grant from the Department of Defense specifically for scandium. So what we have to look at in cases like this, Austin, is what's the market cap? What are the potential risks? And what are the potential upside scenarios? The market cap for this company is about $300 million. You're looking at needing a plant that's going to cost about 1.14 by their estimates. They might be able to shave some of that value off.
Eric, that's 1.14 billion. I just want to be clear there.
Oh, did I say million?
Well, I don't think you specified, but I do want to clarify because we were going from millions to billions. And that's an important jump. So a plant will require roughly 3 to 4 times as much as the current market cap of the company.
Yep, and that's the big risk right now is financing this plant. They're in the process of trying to get the financing for it, and once this is complete, I did some calculations out. It looks like it could produce gross sales in the $200 to $300 million range. So this is something we'll need to do more work on before adding to the portfolio. It's small, it's speculative, but I get why people are looking at these ideas, and it's a natural outcome from this kind of new Cold War scenario that we've been talking about, where we are moving from a phase from kind of the differentiated technologies you need within your sphere of just being warplanes and ships to also a technology element. And so I can definitely see this. We'll need to do a little bit more research, but an interesting suggestion. I appreciate that from Todd.
Yeah, thank you, Todd. An interesting company. Definitely, I would emphasize speculative. Mining is also not our area of expertise, but this company has, IPO'd in 2009 at about $3 a share. It's now about $4.63 a share, and during that time frame, it's been as low as $1 a share and as high as 12. So a very volatile stock. Good narrative and maybe some elements behind it. So worth exploring a little further here, but not our area of strength. So we'll keep an eye on it, though. Thank you so much, Todd. Moving on, Nolan from YouTube asks or says, I'd love to hear more about the boring co-packaged optics play Eric mentioned on the Stock Club podcast. It really appears to be a diamond in the rough if all goes accordingly and without too much risk to boot. Thanks again. Nolan, thanks for the question. Eric, I think this stock is Himax, ticker symbol HIMX. What can you share with Nolan and our listeners about this stock? And also, Nolan, hey, thanks for checking us out on the Stock Club podcast. That was a cool episode with Eric, and appreciate you listening to him over there. Eric, what do we have for Nolan?
Yeah, Himax is definitely a boring stock. I think he nailed it. It's a company that has a lot of sales to industries like automotive. As we've talked about in recent episodes, the automotive industry remains at a cyclical bottom. Semiconductors are inherently cyclical industry. One of the areas that remains depressed is automotives. And so if you can get A company trading at that cyclical trough with a potential catalyst, it's an interesting concept. Now, after Nolan had left this comment, Himax released earnings. They had traded up to 976 before earnings. Here's the negative. They are at 721 today because they issued fairly disappointing earnings. Now, here's the positive, and this is why this stock can be interesting. Its downside is probably in the $5 to $6 range. That's where it's traded in a relative range since COVID. So the closer we get to that kind of range is traded in, the lower downside I would put on the stock. The upside is still to come, and it's not really reflected in the kind of earnings disappointment they just had because the company is working on some engagements for co-packaged optics. It believes can contribute 9 figures, so that's $100+ million in the next year. Now, if your revenue, the revenue for 2025 is estimated to be about $800 million. So if you can get a 9-figure opportunity, that's very big. It's an accelerant for the company, and it could attract a lot of attention. So the bad news, the stock is down since this comment from Nolan. The good news is the closer to that $5 to $6 range, the more interesting this becomes as an opportunity. So I own just a little bit of Himax. It's something I've got. Just sometimes I buy stocks that I'm kind of interested in just to track. And as I noted, I'm definitely it's one that if it gets closer towards $6, is trading at a little more than $7 today, I think it becomes a lot more interesting. Once again, if anyone's listening and saying, what is co-packaged optics? It's a new technology being pushed heavily by NVIDIA, heavily by Taiwan Semiconductor. The idea is that we're going to have a massive change to optics, actually bringing it closer to the chips themselves. It's going to cause a power reduction, and it could be maybe on that boring side that's not noticed unless you're very into technology, but a big shift. One shout out, there's a great YouTube channel called Asianometry, and they just did an episode this past week on co-packaged optics. So if anyone wanted to watch and try and understand what this technology is, they could watch there. But I think it is a space that if you can pick out some winners that directly benefit from this shift to co-packaged optics, that could do very well in the next few years.
Eric, thanks so much for that. And thank you, Nolan. So it sounds like this is sort of a classic, to distill it down. This is a classic asymmetric upside stock, right? Where maybe the downside is somewhat limited. You know, we could see maybe 20 to 30% downside protection, but the upside is potentially very high here, given the potential that it could play in power delivery. So very excited about that one. Thank you, Nolan. Moving on to a couple other questions here. Noah from Portland asks, what is your favorite non-AI stock? Eric, I love this one. You and I have been investors for a long time, although we do talk about AI stocks in the context of this portfolio and the current megatrend we're seeing, and they're some of the most fun and exciting. You and I also have portfolios that invest outside the space. So talk to me about what are some of your favorite companies that are not in the AI space?
Yeah, and I will toss this back to you at the end because I'm interested what you'd say at this time. Now, I will say I had a chance to kind of eliminate all my cost basis across my portfolio at the end of 2013. So I did have an experience where I got to rebuild my portfolio from the ground up. I will say outside the AI space, some companies that I put the largest allocations towards at that time, Netflix and Spotify, companies that have subscription businesses that are able to grow their pricing power over time and are extremely sticky. Both of those investments have done well. Another area that I allocate towards and I really like is foreign marketplaces. You know, a popular company would be something like Shopify, but if you look to Latin America, you've got Mercado Libre. If you look to Asia, you have Sea Limited, which we're filming this on August 12th. Sea reported outstanding earnings before market opened today. And the great thing about those companies isn't just that they have dominant marketplaces, which if you've watched Amazon's share price across time, you understand the potential. There are also winners in kind of the digital wallet space where you can create apps that become kind of everything apps, offering a wealth of services and are able to kind of contribute to lead generation for different areas that a lot of consumers entering the middle classes in those markets need. So, Austin, you know, another thing that I'll do is if I'm investing outside technology, we kind of talked about this with the rare earth question earlier. If I'm getting outside my circle of competence, I'll often just put an indexing component as well. So I do keep some ETFs, and And that is just to keep me honest and let me sleep a little bit easier at night for areas outside kind of the technology space. So, what about you? What are you most interested in outside technology today?
Sure. Thanks for the question. Like you, I tend to park a good deal of cash either in ETFs or Berkshire, as you said, to keep me honest. Also to reduce the potential risk of cash drag. Just having too much of your portfolio in cash and missing upside, even if you end up picking some great stocks. So for me, some of my largest positions right now are Mercado Libre. Like you, I like their optionality and their international exposure, their growth. Just a fantastic company that has so many ways to make money tied to a growing economy. Berkshire is also a large position for me, but something that I've been adding to a lot recently has been Uber. One of the things that you and I have seen over the years, optionality can often be really difficult to underwrite. Amazon is the company it was today, is the company it is today, not strictly because of their retail operations, but because they expanded from books into music and from music into everything. And then they've added AWS and they have a meaningful advertising business. And that can be really hard to underwrite, but that's what allows big companies to continue to grow. And Uber has really impressed me. They survived COVID, which was a dynamic that should have destroyed ride hailing by pivoting to meal delivery, which is now a $1.5 billion business, still growing double digits. They've added a meaningful, larger than $1 billion advertising business. They've got a dominant position in the space, and I like that they are partnering, not fighting Waymo, because Uber has two sides of that marketplace. They have the drivers and the app installed base, so they're in a good position to give Waymo distribution while the autonomous ride hailing space figures itself out, and maybe they're a vehicle for Waymo to get greater distribution for rides or whatever other brand may come down the pike. And management seems to agree. They just announced a $20 billion share repurchase last week. So I've been adding a lot to Uber, but I really like Mercado Libre. It's probably, I think it's a top three position for me right now.
Yeah, and I would say Uber is not one that I personally own, but I would not want to short that company either. A lot of people see that as something that almost certainly will be vanquished during the ride hailing phase. And the prettiest chart in all of finance is the cash flow statement from Uber, a chart of that going from very negative to very positive. They have definitely hit the growth accelerator in the most meaningful of metrics in the financial space.
Yep. Uh, okay, moving on. Alicia from Florida asks, where did you learn about investing? I love this question. Eric, I don't know that you and I have ever actually talked about this. I'm curious how you got involved in investing.
Yeah, it is a great question. I think the most important thing is just to get skin in the game. Probably my biggest claim to fame that I wish had paid off more was the first stock I ever bought was Nvidia, and it was in October 2008. I had just graduated from college recently, and I wanted to get started, so I bought $1,000 in 5 different stocks just to be able to track them. And nowadays, one nice thing about finance, it used to be very intimidating. We see often, what's the stock I can buy that's under
Mm,
$5? That's a popular question because people want more shares of things. The reality is nowadays you can buy fractional shares with just $100. You can go to Robinhood. You can buy fractional shares of a leading company like Nvidia. You can buy retail options if you're someone who really enjoys Chipotle or many other things. And you can just begin tracking many of the businesses that you interface with. You can also buy ETFs. And I think for people being able to get that skin in the game, if you have that skin in the game, the longer you have it, it might be down in a year, it might be down in 2 years. But if you go through 5 years and you've bought a diversified portfolio, it's going to grow. And that's going to start building, kind of seeing firsthand the power of markets. Austin, we do this show specifically focusing on AI, but like the internet became the biggest trend that changed the world, and every stock became an internet stock in some ways, and companies that were internet stocks like McDonald's, you look at McDonald's or Starbucks, their businesses are now predicated on loyalty apps. So they adopted that technology. And I believe over time, if AI turns out to be a transformative technology, it will benefit companies across the entire market. So even if you're not going and you're not buying some of the leading AI stocks, if you're afraid of some of the risk, just being able to own the S&P 500, being able to own stocks is going to get you started on this journey. And I believe they will benefit if this trend is on the level that we expect. So, Austin, what advice would you give to someone getting started?
Like you, I would say, just get some skin in the game and start investing. When you and I started investing, there were still trading commissions. You had to pay to buy or sell a stock, and
Mhm.
that's gone away. You can now buy a stock for $0 on Robinhood, Schwab, or Fidelity. So yeah, just get started. Any dollar amount makes it interesting. My first stock was Green Mountain Coffee Roasters, which I bought because I was raised in New England, and it was a company that was close to me, and their K cup seemed really popular at the time, and that was it. But it got me interested in investing, and I followed the company. It actually brought me to the Motley Fool, which is how you and I met, because the Motley Fool covered that company a lot during that era. And it's fun to follow the story of a company and learn about them. And boy, I made a lot of mistakes on the way. But if somebody was getting invested, wanted to get invested today, I would say just buy some shares in a company that you're interested in following. Stay humble, right? Listen to some other voices out there, because you're amazed at what you can learn when other people share their ideas, both for and against any company. Don't be afraid to borrow ideas and make a couple bets here. But it's like picking a sports team. Once you make an investment in any company, you're kind of rooting for them to win. And sports is a wonderful pastime. And investing has the nice corollary of being one you can make a significant amount of money on if you pick the right team.
Yeah, it's kind of a wonderful world we live in that you can succeed just by doing nothing and getting a share of what these companies do. I always laughed when people would complain to me about Ticketmaster prices. I would say, well, you can just go buy the company. If it is so unfair,
Right,
you can actually just own it
right.
and get the cut from this being so unfair. And it's a great point you brought up too about trading being free. When I started, main brokers were still charging $50 per trades, and you got to pay that on both sides. It was very intimidating if you wanted to buy $1,000 of
Mhm.
stock, and we went down to $7, and now it's almost universally free to buy a stock. So that is a wonderful service that's happened, and it's been enabled by trends like the internet.
Eric, I was actually going to add one little extra note here, which is getting children involved in investing. One of the things that we
Yes.
do with our kids that has worked really well for them and got them interested in companies, we give them an allowance every week, and any money from that allowance that they want to invest will match, but it has to go into an account that they can't touch until they're adults. So if they get their $20 allowance and they want to buy $5 of Coke or Nike, we give them another free $5 to do it. So we double their investment. They don't always take advantage of it, but it's given them, small portfolios with companies they know and recognize that they want to win. So a freebie out there for any parents maybe looking to get their kids involved in investing.
100%.
So moving on, we have Brad from Arizona who asks, why isn't Alphabet a more interesting AI stock? It has the biggest sets of data, referencing Gmail, YouTube, obviously search. Gemini is a top performing model, and I think we want to be clear that's on like performance benchmarks. And the core business still makes billions of dollars. Brad brings up a lot of great points here, Eric, but Alphabet is not in the portfolio. So why isn't it more interesting and compelling today?
Yeah, it's a great question. If someone went back and listened to this podcast, they would see at the beginning, back in the fall of last year, I was very worried about Alphabet or Google. We'll just call it Google. That's a little easier. And I kind of have turned around on it as the show's progressed, and I am far more bullish on the future of Google right now. So it's not one I would be opposed to adding to the portfolio. We are going to be selling down Amazon and Meta. So some of the larger stocks we had park cash in, we are reducing our exposure to that. But if you're getting started and you're someone listening to this and wanting to build some starter positions, I think Google is a great place to start. As was mentioned, they make a lot of money. Their search business is still strong. It actually exceeded Wall Street expectations over time. There are some competitive threats there, but those threats are also balanced by the fact that Google, they have a cloud business. There are three leading cloud companies in Amazon, Microsoft, and Google is significantly outgrowing Amazon in the cloud space because they had made a first bet into kind of courting AI companies. They also made a major bet building out their TPU. It allows them to run many of their AI models on custom hardware and chips that they designed for this purpose. That's been a very ahead of the curve concept from Google. And it's another reason that we own Broadcom in the portfolio. So we're winning from multiple dimensions thanks to TPUs. So they have a very strong cloud division. That's the third company in terms of market share, but one that is growing very strongly. They also have DeepMind, which they bought and is an asset which would be worth an incredible amount today. Their AI models often compare very favorably to competitors, and it's just about getting distribution to consumers. YouTube is a crown jewel asset that is worth a significant amount of money. There's Waymo, as we discussed earlier, among other areas like their ad network, which is extremely valuable. So when you sum of parts Google, it is an extremely compelling idea, and I couldn't blame anyone for doing a starter position. And it's a company that I won't be averse to adding to the portfolio either. So I think that's a wonderful question from Brad.
Wonderful. Eric, I love that. This is our, we achieved our speed run goal here. This is going to be our shortest episode yet, but I really enjoyed this, and I hope the listeners did as well. A reminder to our listeners out there, you can send us your questions at 247wallstreet.com. Eric, do you mind closing us out here and maybe giving us a preview of the next episode? We're going to be recording another one shortly here, and you want to give listeners a little sneak peek about what we'll be talking about?
Yes, as you know, this is a bonus episode. We want this to be a community. We want people to feel like if they have questions, they can come to us and get answers. I know we've talked about that since the beginning, but we've made investments. We're building out our YouTube channel. We have more resources to be able to answer questions in a more full-featured way like we did today. Now, I will say we'll be coming back with a regular episode on Friday. We're going to be discussing the biggest model release of the year in GPT-5. We're going to talk about some bullish areas for the portfolio, like Micron's earnings and what that means for the future of it and other companies in the memory space that we've talked about. And I plan on making some purchases. There is a massive trend going on right now where software stocks are just getting shellacked left and right. We're going to talk about that, and we're going to talk about separating some of the winners from the losers in the space at what might be some very compelling values emerging. So, Austin, we're going to have a lot of news. We're going to have some buys. It's going to be a great episode. We expect that to drop on Friday.
Love it. Thank you, Eric, so much. We'll talk to you then.
The AI Investor Podcast is for educational purposes only and should not be considered investment advice.